Every weekday morning, trillions of dollars flow through the global financial system in what appears to be pure, unadulterated chaos. Most beginners look at these rapidly moving charts and see random noise or a secret mathematical code they can somehow hack. Approaching the market like a casino leads to impulsive trading, buying because a line goes up and panic selling when it drops. Zooming out reveals a hidden structure. Despite the noise, prices constantly bounce between invisible, repeating boundaries. An unseen floor holds prices up, while an invisible ceiling pushes them back down. The financial system breathes through the collective anxiety and reactions of the people trading within it. Learning to identify these boundaries, known as support and resistance, allows you to read a physical map of human emotion. This diagram shows how price behaves around key levels. Support acts as a floor where buyers become interested enough to stop a decline. Resistance acts as a ceiling. It is an area where sellers decide to take profits, halting in advance. Beginners often make a critical error by treating these boundaries as mathematically precise lines. These zones function like neighborhoods. Since the market reacts within a range, price rarely reverses at a single, exact penny. Identifying these zones prevents fatal miscalculations, such as missing a trade because the price turned around just before hitting an exact target. Prices bounce repeatedly because the people making the trades remember what happened at specific prices in the past. If a stock hits $100 and bounces, traders take note. When the price returns to that level, they remember the previous bounce and buy again, creating support. Resistance forms the same way. When a stock hits a high and drops, sellers remember that rejection and become active when the price approaches that level again. Humans naturally fixate on round numbers like 100 or 1,000. These milestones become massive barriers because millions of traders watch them simultaneously. Support and resistance levels are the physical manifestation of collective human memory and focused attention. Broken floors frequently transform into new ceilings, a phenomenon known as role reversal. When a support breaks and price drops, traders who bought at that floor are trapped in losing positions. When price rallies back to that old line, those trapped buyers sell to break even, turning old support into new resistance. This exact behavior stems directly from the deep human desire to erase a painful mistake and quickly escape further financial ruin. When a price wall finally collapses, volume acts as the market's polygraph test, separating true breakouts from dangerous traps. A breakout occurs when buyers completely overwhelm sellers and push the price outside the established zone. Many of these moves are fakeouts, which are temporary pushes designed to lure traders in right before the price collapses. Massive volume provides evidence of conviction, whereas a breakout without significant participation remains a mere rumor. While amateurs buy on a whim, disciplined professionals wait for hard data to confirm their ideas. Mistakes include treating zones as exact prices, buying without confirmation, and trading against a dominant trend. A professional framework involves identifying a strong zone, waiting for the price to arrive, and watching for volume to confirm that buyers are returning. You enter only after confirmation, placing a stop loss directly below the support zone and targeting the next resistance level for profit. This framework turns trading into the systematic management of risk and reward based on probabilities. Long-term investors utilize these same concepts to time their entries into great companies, ensuring they don't overpay at a peak. Identifying where supply and demand have fought before provides a massive advantage over those guessing at random movements. By reading the human behavior written into price charts, you stop gambling and start understanding the true story of the market.